Okay, we're going to look at exercise 20 about how to compute the operating activities cash flow using the indirect method. That is the hardest section to do and the only section that is different between the indirect and the direct method. So this is the problem we are looking at. The accounting records of CD Sales Incorporated include the following accounts. So we already know the cash balance started at 7,500 and the ending balance is 6,500. So if we were doing the whole cash flow statement, the change in cash would be a decrease of $1,000. But we're only going to do the operating section. We can see here that accounts receivable went down, and we can see that merchandise inventory went up and accounts payable went up. So make sure you calculate those differences so you will know how much of an increase or a decrease there is. So let's go ahead and continue to look. We have accumulated depreciation, and you can see that depreciation expense for the month of July was $2,000. So we also see that we paid some dividends, and we can see that net income was $50,000. Now we don't need to worry about dividends if we're doing the operating section. We're only looking at current assets and changes in current assets other than cash, and changes in current liabilities, and depreciation, and if we had any gains or losses. We do not have any information about selling equipment or anything, so we don't have to worry about gains or losses here. So let's go ahead and let's look at, I've already started the spreadsheet. So here's our statement of cash flows. I've already looked at, we already looked at net income. So if we go back to net income, we can see that net income is $50,000. So we will go ahead and put in net income of $50,000. Now we have some changes that we have to do. Remember, depreciation expense. This expense has been subtracted out of the income, so it's been subtracted out already, but it does not affect cash. So we need to add it back, because we do not spend, we do not write a check or anything or use cash to pay in this expense. It is not a cash expense. So what we need to do is we need to add back depreciation expense. It was $2,000, I believe. Now let's look at our next account. Accounts receivable went down by $3,500. So let's think about it for a minute. When we record, when we increase accounts receivable, we debit it, right? Okay. When accounts receivable has a normal debit balance, so the only time I debit accounts receivable if I'm making a sale on account. So it would look something like this. So let's say we made a sale of $500. Okay. So what happens here is every time I make a sale on account, it is included in net income. Now, when I receive cash for the account, that means I get, let's say, cash of $2,000. When a customer pays us, we record it. We record the cash, and we decrease accounts receivable for the amount that they paid us. So what happened here was we collected more cash. We had more entries that looked like this than we did that looked like this. So all my revenue has been recorded, but if my accounts receivable went down, that means I collected more cash than I did sales, than I had sales. So cash, I'm actually getting more cash than the sales that I have recorded. So what's going to happen is cash is actually going to increase. Okay, so accounts receivable decreased by $3,500. So that means I received more cash than I had sales. So a decrease in accounts receivable is an increase to cash. So when we're going to add it back to net income. So a quick reminder is, if we're talking about current assets other than cash, when we're doing the indirect method, the adjustment to net income, when there's an increase in the current asset, if there's an increase in the current asset, then the adjustment will be a decrease to net income. If there's a decrease in the current asset, if it goes down, if the account decreases overall, it is an increase to net income. So right here we had a decrease, and I explained why. But if you want to remember, the shortcut is, if the account decreased, it's an increase adjustment to net income. Okay, then we have an increase in merchandise inventory. Let's talk about merchandise inventory for a minute. When we buy merchandise inventory, we debit merchandise inventory and we credit cash for the amount. Okay, so when we get ready to sell the inventory, when we purchase merchandise inventory, we record it as merchandise inventory and cash. And then when we get ready to take the inventory off, what we're going to do is we're going to debit cost of goods sold and credit merchandise inventory for the amount. So let's say $500, for example. So if you look at our problem, merchandise inventory went up. Okay, so what that means is we had more entries like this, meaning that we ended up buying more than we actually sold. So what happens is we ended up spending more buying it than we actually sold. So what happens to cash is we're spending more, so that means cash is going to go decrease. So if you look at the decrease, it is $10,000. Now, what does that mean? Let's think about what that means here. This is a current asset. The current asset increased. So what will it do? What will the adjustment be? It will be a decrease. Okay. And I meant to... Okay, there we go. Now, the last entry is an increase in accounts payable. And I will talk about the shortcut for that in just a second. But with accounts payable, what happens is when we buy something or when we have an expense, we're going to debit expense when it occurs, and we're either going to pay the expense or we're going to do accounts payable and pay it later. Okay, so remember, when we make this entry, it's on the income statement. It decreases net income. Then later, when we pay it off, we would debit accounts payable and we would credit cash. So what happens here is when we expense it, nothing's happening to cash. Okay, but let's just say when we pay it off, when accounts payable decreases, cash is going up, because cash is decreasing because we're paying our account. So what happened here is accounts payable went up. So what happened is we're expensing more than we paid in cash. So we are expensing more than we paid in cash, meaning that we're not spending as much cash. So we need to add that back to cash, $4,000. So let me say this again. If accounts payable goes up, that means that we have more cash because we're not paying it, we're just charging it. So cash is not really being affected. We still have the cash. So I'm just using these random numbers over here, but where I actually got the 4,000 is the change in accounts payable. Accounts payable went up, which means I'm charging more and I'm not using my cash. So I still have an influx of cash because I'm not paying my bill. Okay? So with that being said, when we think about the relationship with current liabilities, what happens on the operating section? When we have a change in account, an increase in current liabilities, like an increase in accounts payable, the adjustment is going to be an increase to net income. It's a direct relationship there, increase. If our change in our current liability is a decrease, the adjustment is going to be a decrease to net income. Okay? And it's easier to remember this than to understand why. The explanation behind the why. You can just memorize this, okay? If you're going into accounting or majoring in accounting, you need to understand why this account does this, like understand the entries behind it and why it's increasing or decreasing. But if you're just wanting to prepare the operating section of the statement of cash flows, this always works, okay? So now what we need to do is we need to calculate a net here. This would be 5,500 and this would be 9,500 if you added all your positive numbers up. So 10,000 and 9,500, the difference there would be 500. I just netted those out. You know, you could have just used the Excel to do the calculation for you. Now, I don't know why I keep doing that. What I will do is fix this so it looks like what it's supposed to. So our net cash provided by operating activities, after all of our adjustments to net income, you take the difference here because this is a $500 difference. And there it is. Our net cash provided by operating activities is $49,500. The operating activities section is the hardest section of the statement of cash flows. So once you get this section, the investing and financing sections are not bad at all. And that concludes this exercise. Exercise 20, and it's on page Appendix B, page 45 of your textbook.